The $3 trillion market, nobody is starting to crack, and it could hit everyone. Good day to everyone. Welcome to the video of the day. This is 3 trillion market most people have never heard of. It doesn't trade on exchange. It has no daily prices. It is completely unregulated compared to banks. And right now it is cracking. Two of the world's biggest asset managers, Apollo and Ares, just blocked investors from withdrawing their money. This is the private credit crisis, and it could be the thing nobody was seeing to come. We'll start from it. So, first of all, we'll discuss what is private credit. Let me explain what private credit is because most people don't know. So, after the 2008 financial crisis, regulators forced banks to stop lending to risky companies, and the Volcker rule, Diesel 3 capital requirements, and the banks pulled back. So, who filled the gap? The answer is private credit funds. Name is Apollo, Ares, Blackstones, Blue Owl, KKR. They lend directly to companies, most middle market business that can't access public bond market. So they charge higher interest rates, they keep the loans private, no daily market price, no public disclosure. The market grew from zero in 2010 to nearly $3 trillion in deployed capital today, the fastest growing segment of global finance. And the direct lending now represents nearly $2 trillion in deployed capital in the US alone. For middle market borrowers, it offers a reliable funding partner. For investors, it delivers a yield premium over public credit. And for pension funds, insurance companies, sovereign wealth funds, wealthy individuals all poured money in attractive yields of 10 to 12% in a world where bonds paid almost nothing. But now the rates are high. The Iran wars hit supply chains. AI is destroying the business model of the companies these funds lend to, and the cracks are showing. So, how the crisis unfold right now only. Here's what happening right now in the plain language. So Aris management opted to curb investors withdrawal from its $10.7 billion private credit fund just a day after Apollo Global Management unveiled the similar measures in of its vehicles. Even Blue Owl also paused the quarterly redemptions, a move that underscores what Howard Marks called plainly at XP Global Conference in March 26. And here's the number that should stop you cold. Around 40% of private credit borrowers now have negative free cash flow, a sharp increase from previous year. This means that companies are not generating enough income to cover their expense, and the headline default rate is 2.1%. But when adjusted for liability management, exercise, and shadow distress, the rate approached to 5.4%, and Fitch puts that actual deficit rate at 5.8%. So these companies aren't going bankrupt. They are using a tool called payment in kind, where instead of paying cash interest, they issue more debt, and the mountain grows, the cash never arrives. Warren Buffett had said in a good and best way that only when the tide goes out do you discover who's been swimming next. The tide is going out. So everyone is saying that there is some AI connection. Yes, definitely we'll be discussing on it. So here's the angle that connects this directly to everything we have covered in last few days. Private credit funds lent heavily to software companies. Software was a perfect borrower, asset light, recurring revenue, in high margins and easy to underwrite, easy to value. Then AI came. If AI puts those attractive cash flow streams at risk, there are few to no assets to liquidate to repay the lender. And within sector specific lending, market participants broadly expect new software related direct lending transactions to price at a premium of approximately 75 to 100 basis point. So in a translation language, I would say that the companies that private credit funds lend to are now being disrupted by very AI boom, and that's driving stock market to record high. The S&P 500 is celebrating the private credit market, which lend to the companies being disrupted by AI, is quietly suffering. So two economies, one booming, one cracking, and the most retail investors only see one of them. What does it mean for us as a financial part? Private credit is a broad asset class that is roughly 40 trillion in size globally and encompasses non-bank lending and debt investments that are not publicly traded. So the key risk is the liquidity mismatch, and the private credit may offer high yields but long dated, hard to sell assets. And when redemption hit critical mass, the withdrawal will be restructured. Few things to watch to manage your funds. One is PDC price, second is PIK ratios, and the third important part of it, I would say, the redemption gates. companies like Apollo and Aries. We expect 26 and 27 will become the years where performance is generated through restructuring expertise. Make sure to like the video, share it with your friends, family, colleagues too. Welcome to Money Brief. Let's grow together. See you then.